behind the diversity of shareholders, and how is that reflected in different business models, and how's that related to stewardship capability?
Well, there are a variety of agents who can take on the role of steward. I think the ones who are most able to do it are shareholder activists who take a large position in a company and really have the conversation that stewardship seems to be all about, which is, we want to change the strategy or we want to change how you run the firm. So I think those are maybe the ones who have the strongest incentives to engage in stewardship the way I think it's envisioned in the code. After that, you have large institutional investors who own big stakes of every firm just because they are so large. And I think they also have a role to play in the stewardship debate. And they obviously have the clout to engage with companies as well. However, they own stakes in so many companies. So, if they put a lot of effort into just a few companies, it doesn't matter for their overall portfolio. So it's maybe a little bit less of an issue for those firms. But they can still engage in stewardship the way I think it's more traditionally defined, which is engagement with the companies. For smaller institutional investors or retail investors, all you really can do is vote. Engaging with the firm, it's not worth your while, and the firm is also probably not going to listen. But we perhaps underestimate the importance of voting, and there is good evidence that just expressing your vote does actually lead to governance changes, which is what stewardship should also be about. There is a final set of actors, sovereign wealth funds, who play a little bit of a stewardship role, but you have to be a little bit careful with sovereign wealth funds because they may have other objectives in mind. Now, there is another element of stewardship, though, which is just voting with your feet, which is buying and selling stock. And I don't think the code kind of thinks about stewardship in that way, but voting with your feet can be very powerful because if we all do this, it will depress the stock price, and that could get the other governance mechanisms to work. So I think we need to perhaps think about stewardship a little more broadly than just to say, oh, we just need to engage with managers and there's nothing else to it.
Do you think that this diversity is adequately reflected in the current debate around shareholder stewardship?
I mean, the way I think stewardship is currently framed is very much about engaging with companies. And I think only a small subset of investors actually have both the expertise and the time and the clout to actually do that. And so I think the stewardship code doesn't really pay much attention to this issue. And ultimately, if you force stewardship on a bunch of investors who don't have the time or the money to engage in it, then that will ultimately come at the expense of returns because, of course, they have to expend the effort. The code also, I think, doesn't really pay enough attention to the fact that just doing your research and buying and selling and voting with your feet if you don't like what's going on, that really is also stewardship. And then finally, the code, of course, also tells stewards that they should engage with companies on environmental and social issues. Now, that's also a very difficult aspect to achieve, particularly because sometimes there are trade-offs between environmental and social issues and maximizing the wealth of the investors. And how can you expect a pension fund to give advice to companies that would reduce the payoffs for their beneficiaries ultimately? So in a nutshell, I don't think this variety of business model is well reflected in the current stewardship code.
And in your opinion, has the problem of short-termism been exaggerated?
I mean, short-termism is almost become an assumption now. We assume it is there, but I actually think there's relatively little evidence to support that this is the case. And there are many companies that you can look at today that could not exist in a short-term world. Amazon would have never survived. Uber would not survive. Tesla would not survive. Glaxo has a very long product pipeline. These are not companies that could survive in a truly short-termist world. I think what sometimes happens is that maybe companies should look a little bit in the mirror, and maybe short-termism comes from the fact that companies set very short-term rewards. And as a result, of course, their executives are going to go for very short-term objectives because that's aligned with their rewards. So perhaps short-termism is not induced by investors as much as it is by the reward systems that are there in companies. I think there's also a bit of confusion between having a short-run investment horizon and the way you think about companies. If I know that a company is going to make a bad decision and I sell my shares and everybody else follows, and as a result of that the company doesn't make the decision because it sees its price drop, that's a long-term decision that the company is not taking that I've influenced by a very short-term decision. And so if I want to buy or sell a share, even if I want to sell it back after 1 year, I need to think about the long run of the company, because you always, even if you only have a 1-year investment horizon, you always have to put yourself in the shoes of the buyer that you're going to sell your shares to next year. And so short-term selling still requires long-term thinking.
Do passive investors make good stewards?
Well, on the face of it, you would think that passive investors should not make good stewards, because ultimately they just want to track the index, and so what's in it for them to try and improve company performance, because it's just going to help everybody else. And now, if you look at the data, funnily enough, there does seem to be some evidence actually that index funds do help with some some aspects of company performance. There are, for example, more non-executive directors in companies that have more passive ownership. The other thing that passive ownership seems to help with is activism. So when activists target companies, they're more likely to look into companies that have a bunch of passive investors, because those passive investors, the activist needs to get them on board, and those passive investors are not going to go away. They can't. They need to be there because they're tracking an index. So they actually seem to help and enhance what it is that activists are doing. So there is some evidence there that passive investors can actually help with stewardship, which is maybe not what you would expect. Now, having said that, though, ultimately, if two passive investors are competing, and one is, they're going to both try and track the index, if one is spending a lot of money on stewardship and as a result has more expenses, while the second one is not, then investors might ultimately flock to the second one. So if you just look at it from a cost perspective, there is a risk that with more passive investment, there's going to be less money spent on stewardship overall.
You say that common ownership may lead to collusion versus competition. Can you explain that?
Sure. So, what does common ownership mean? There are a bunch of institutional investors now who are so large that they own stakes of many companies, of most companies actually, including large stakes in many companies within an industry. And if I own a substantial stake in 4 or 5 players within an industry, if I own 5% of Exxon or Chevron and BP and Shell, the question is, what would I tell these companies to do? And you might, and I'm very careful here, I'm not saying that this is happening at the moment, but there are suggestions that it might be happening, and this is certainly a topic of conversation among regulators. But what you might tell these companies to do is not to compete with each other, so that essentially they can all make more profits together, which is fantastic for the investors, but of course which is not good for society, because ultimately it's all of us that are going to have to pay the higher petrol prices that would come out of that. Now, I'm not saying that this is what's happening at the moment, but I think people are concerned. We would never let BP, Shell, Exxon, and Chevron merge because that would be anti-competitive. But if one large shareholder happens to own a very big stake in all of these companies, you may end up possibly with the same effect. And it's just something I think that we need to be cognizant about, that this is an issue. And I think more research is required, I think, to see whether these allegations are actually borne out in the data. But it's certainly something that's being talked about.